Baba is what we are going to be covering today. Okay. And I am going to show that here. Let me take this off. We don't need this off. Okay, good. Now, guys, look, what you are looking at is a 2-minute chart of Baba, right? And all of you should know by now that the two main moving averages I rely on are the 20-period simple moving average, that's the blue, all right, and the 200, that's the red. Now, I'm always telling you that it's important to look to the left, all right? This is something that I want this to be a mantra for you. I want you to constantly look to the left, all right? Now, if we go over here with Baba, right? And we note that the two moving averages are very close together. All right, they're pretty much kissing each other. They're pretty much one moving average. That's how close they are. That is indicative of Baba being in a narrow state. Okay. Now, how many times have I told you that your very best trades are going to occur from a narrow state? You're going to get the greatest amount of flow from a narrow state. Why? Because narrow states lead to wide states, either up or down. Now, we can't know, all right? We can't know what direction. So before Baba opens, we know that Baba has a narrow state from its late day activity the prior day. Okay, so we know this before the market opens. We don't have to know whether or not the Baba is going to move out of its narrow state to the upside or downside. We don't have to know. All we have to do is wait. And when we wait, we just want to see power above the narrow state or power below the narrow state. This could have just as well been power beneath the narrow state in the form of not a green, but a red bar, right? We could have had this, right? It would have made no difference. Then that play would have been to the downside. But we didn't have we didn't have Baba opening with red power beneath. We had Baba opening with green power above. So that's the direction we play the stock in. Now, this is an elephant that is big enough, right, to buy right into the bar. So I want you guys piling into Baba before this 2-minute bar finishes. All right. And the general guideline is as long as you're entering in the second minute, not the first minute, as long as you're entering in the second minute of that bar, you're okay. Minute and 15 seconds, minute and 20 seconds, fine. 30 seconds, no. All right. No. That first minute, traders, is the most unreliable minute of the entire day. We need to get that 1 minute out of the way. All right. And we need enough of the 2-minute to be finished to be relatively certain that this bar is going to close pretty much the way it looks now. All right. Like, we don't want enough time in the bar to radically change the picture. Right. So, if you're buying 5 seconds into a 2-minute bar, that's almost an eternity. That bar can turn around, become a different color. But so, I generally like to get in on an anticipation entry, like a minute and 30 seconds, a minute, 20 seconds, like in that area. I know that most of the 2-minute is finished. and it's likely not to be able to change its nature from what it is very easily. All right, so we're buying into that bar somewhere around a minute and 15, minute, 20 seconds. Boom. Okay. Now, under normal circumstances, my stop would be under this bar because that bar is the reason for my buy. I don't like markets that take out the very reason for my trade. So my stop is usually there, but whenever the 200 is close by my stop, so I would be getting stopped out right there. That would place me being stopped out right by the 200. That's not happening, right? The 200 is our biggest help. I'm not getting stopped out at the help. All right. I get stopped out under the help, but not at the help. So whenever I'm in this scenario, I have to go with a numerical stop amount. And so every one of you needs this numerical stop amount. What's your maximum loss per trade? Now, if you don't have a maximum loss per trade, I'm going to give you a general guideline. You have to first arrive at what's the maximum amount of money you don't want to lose on any given day. So let's say that's 200. I don't ever want to lose more than 200 on any given day. Now, you can divide that by 2 or 3, your choice. If you divide it by 2, obviously it's 100. Okay. Now, can you go for yeah, you can. I don't like stops less than $50. I don't like them. I'm not saying that you won't have some stops that are less than 50. Yes, I don't like maximum stops. I like stops that are less than 50 if that's what the stop is. Like as an example, guys, if I were to buy this RBI right here and put a stop there, that would be a stop less than $50. But that's what the chart is telling me. I don't like maximum losses per trade. I don't want my maximum to be that small. Maximum needs to be a little bit larger. Okay. You can go too small with your stops, guys. This is a problem too. You know, everything done in excess is always bad. And so you can take your stocks so little, put them in such a tight straight jacket that you're going to die by 1,000 cuts. Your stock is going to stop you out all the time. All right. So stocks, like human beings, need room. They need their space to operate in. They need to be able to bend their knees a little bit. You know, they can't be put in such a tight straitjacket. So anyway, entering into the bar somewhere around a minute and 15 seconds or so, minute, 20 seconds. My maximum, let's say my maximum is $80. And that would mean that, okay, if I do one lot, if I do $1, I've got 80 cents. If I do 100 shares, I've got 80 cents. If my stop is $100, and that's what I'm going to use, my stop is $100 maximum. With one lot, I can go $1 below. All right. With two lots, I'd have to go 50 cents below. So in this case, we're going to use one lot. All right. Get that stop somewhere as low as we possibly can. And guys, look, if your maximum can't get you below the 200, then you have a choice. Just do the maximum wherever it is, or don't do the trade. Okay, but stick to your maximum. Don't break that maximum amount. All right, so anyway, in this bar, your stop should be below the 200. If you can't, put it wherever you need to put it. All right. And guys, there's not much else to talk about here other than, you know, the first time you get green taking out red is way up here. It's just a super trade today. Okay. And I'm always telling you to go after what's called whale complete. That's your whale complete right there. Okay. So there are three types of whales that we go after. This is your traditional whale. We want that play right there. Sometimes the whale occurs like that. So instead of this being slanted down, it's on its side, right? And sometimes you just get the brief pause whale. Brief pause, boom. Now in the brief pause, you want relatively equal moves on each side of the pause, right? Boom, now you've got whale complete there. So here we get this, I would say, is more like the brief pause in a way. All right. But there's your whale complete. And it's never, it doesn't have to be perfect, but that's definitely whale complete there. All right. Anytime you want to go for more after a whale, the very best trailing stop method is the big bar moving average combination. So I want to cover this with you. This is the best way to really go after multiple whales. So you've got your whale, right? You have a right to take the whole trade off unless you want to try, since it's such a big winning play. Let's see if we can get more. I'm going to leave a single lot in here and let's just let this thing go. Well, here's in my opinion, the best way. Every time you get a very solid bar, you're going to anchor your stop under that solid bar. So here would be a solid bar, right? There would be a solid green bar, solid green bar, solid green bar. You see what I'm saying? Solid green bar. Anytime you get a really nice stop, you're going to anchor your stop there. All right. But if your moving average passes the stop, you're going to flip to the moving average. So here's your bar. Here's your stop. Here's the moving average. Uh-oh. Here's the moving average coming. All right. Here's the moving average coming. Now the moving average passes the stop. You see? Now you're going to go from the bar to moving average until you get another bar. Okay? So you're going to track the moving average until you get a fat bar. The fat bar will form before the moving average gets there. Yes, it will. Before it's past it, actually. So then you would anchor on the bar until the moving average, right? Is that a different color? So the moving average goes past the bar. Then you revert back to the moving average. Then you get the bar, you anchor on the bar until the moving average passes the bar. Now you're back to moving average. Then you get another bar until the moving average passes the bar. Then you go back to the moving average and you just roll. Big bar, moving average. Big bar, moving average. Big bar, moving average. And you can see the 20 keeps you really in this trade a very long time. Now, which moving average, excuse me, guys, which moving average do you use? You need the stock to pull back to let you know. So see this pullback? It pulls back and it reacts off of the 20. That's telling you you've got to use the 20. Sometimes it'll pull back to the 8, right? It'll pull back to the 8-period moving average and react there. And then that stock is telling you the moving average I'm acting off is the 8, but sometimes it'll be the 13, right? These are the 3 or the 20. So you can either get the 8, the 13, or the 20. In this case, you get the 20, but you need one full pullback and a rally to let you know what's the key moving average that the stock is reacting off of. Tell me you understand that, guys. Does that make sense? Does that make sense? You need a successful pullback to reveal what's the key moving average. You don't choose that. The stock chooses that. All right. Okay. Good. All right. So Simon, yeah, you're in the live, my friend. How can you be in the live asking, is there live? I don't understand that. But yeah, you're in the live, my friend.